Hey, what's up, my friend? So in today's training, you will discover an enhanced turtle trading strategy that has been backtested over the last 20 years. And here's the results of it. Okay? And in this training video, I will share with you the exact trading setup, right? The entry, the exit, the risk management, the markets to trade, so on and so forth, right? The full strategy will be shared with you. But first, right, some of you might be wondering, hey Rayner, what is the turtle trading about? Who are these, turtle traders that I've hear, so often? So let me share with you a story. So back in the 1980s, right, there were two traders, right, Richard Dennis and William Eckhart, and they had a bet with one another. Richard believes, right, that trading can be taught. He believes that I can just, pick up someone random from the street, share with him my trading rules, and that guy can be a trader. Whereas on the other hand, William, he doesn't believe that trading can be taught. It's something that either you have it or you don't. So clearly they both had a slight disagreement. So in order to find out who is right or wrong, they decided to do an experiment. So what they did is that they hired a group of traders, random people on the street, right, to just come for an interview with diverse backgrounds. Some could be an accountant, some could be a gamer, whatever, right? They just came in for an interview, answer a series of questions, and they selected a few of them for the experiment. And this group of traders, they are called the turtle traders. They are known as the turtle traders. So they went through a 2-week training program where Richard and William taught them everything they know about trading. They taught them their trading strategy, the rules, the risk management, and so on. And after 2 weeks, they went on their own to trade Richard's money, right? I mean, amazing, right? You got free trading education, you got money to trade. Yeah, so they went on their own to trade the markets using Richard's money, and maybe William, I'm not sure. Yeah, and how did they fare? All right, so that's the question. So what's interesting is that this group of turtle traders, they did exceptionally well, right? They went on to make triple-digit returns, right, over a number of years in the 1980s. So that experiment, right, you can conclude that yes, Richard, he won the bet, right? Is that trading can be taught. But at the same time, right, William didn't necessarily lose the bet as well, because if you fast forward, let's say 20, 30 years to today right now, the turtle traders, right, most of them are no longer trading the markets. Only a handful of them, right, are still in this business. So yes, you can say that in a way, right, not all of the turtle traders, right, have a lasting career in trading. So in a way, not everyone can be a trader, okay? So at this point, right, many people were wondering, oh, okay, man, so what were the turtle trading rules about, right? How is it so profitable, making triple digit over a number of years? And that's what you're about to find out right now. I'm going to share with you the original turtle trading rules. Sounds good? Then let's get started. So the original turtle trading rules, okay, it's this, right? It's very simple. You buy when the price breaks above the 20-day high. Your stop loss is 2 ATR from your entry price. Your trailing stop loss is the 10-day low. This means that, when you buy the breakout and if the price, goes in your favor, and then it starts to retrace or pull back, if it breaks below the 10-day low, you will exit the trade. Your risk management is 2% of your trading account. So the markets that the original turtle traders trade, right, are this bunch of markets, right? They trade the bonds and interest rates, commodities, energy, and currencies. So let me share with you an example, right, of how this trading setup looks like. So I've got my chart over here. Okay, so remember the turtle traders, right, they buy when the price breaks above the 20-day high. So how do you define the 20-day high? I mean, you can look at your chart, you can eyeball and find out, did the price breaks out of the 20-day high, right? You can just do it, or to make your life easier, you can use a tool like the Donchian channel. So let me explain briefly how Donchian channel works. So this line over here, right, this upper blue line, okay, basically plots for you the 20-day high. So you don't have to do the manual calculation yourself. Just see this blue line and it tells you, where is the 20-day high. And likewise, this blue line over here is the 20-day low. So if you think about this, right, from here, okay, let's say from here all the way down to here, right, where is the 20-day high at this section over here? Okay, if you look at this blue line, right, it says that the 20-day high is at this point over here. So this means that this particular candle over here has made the highest high over the last 20 days. And this candle over here, okay, made the lowest low over the last 20 days. That's how it works. So clearly, you can just go back in time, okay, if you look at this. Now, where is the highest high over the last 20 days? Clearly, it's not made by this candle. It's actually made by this candle over here, this one here. So the candle, this one over here, right, is the high over the last 20 days. So at this point, this current candle did not break above the 20-day high, because the 20-day high is at this point, which is drawn by this blue line over here. But on the next candle, you see the wick, right? The upper wick has now touched the blue line. This tells you that the price has now made a 20-day high. Make sense? Okay, so now this is a valid trading setup as the price has made a 20-day high. So what you'll do is that you'll buy on the next day open. So when the market open the next day, okay, on this red candle, you go long, you buy. On this candle, you buy over here. And at the same time, right, this particular candle also made a 20-day high, which is not surprising. Okay, so anyway, on this candle, you go long on the open. And your stop loss, if you remember, is 2 ATR. And it's again very simple. You just pull out the ATR indicator. Okay, and just find out what is the 2 ATR value. Okay, so if you look at it right now, the current ATR value is about 148. But let's make my life easy. Let's say it's about 150 points. So 2 ATR is just multiplied by 2 is equals to 300 points. So what happens is that your stop loss, right, is 2 ATR. So very simple, right? Let's say the market opened at this price, let's say it opens at 2800, okay? Let's say the market opened at 2800 on this candle over here. 2800. So your stop loss, right, is just 2800 minus 300. Why 300? Because 300 is 2 times the average true range, or the value. And your initial stop loss is 2500. Make sense? Which is somewhere about here. That's their initial stop loss. So now if you recall, right, it says that if the price does move in your favor, you will trail your stop loss using the 10-day low. So again, this candle you open and you can see that the market, yep, it did went in your favor. Okay, so now the question is, how do you trail your stop loss? So again, to find out what's the 10-day low, you can just adjust the Donchian channel settings. From 20, you just change to 10. And now, what happens is that this upper blue line is the 10-day high, and this lower blue line is the 10-day low. So all you are looking for is for the price to touch the lower boundary of this blue line. If it touches it, it means that the 10-day low has been hit. So you fast forward, okay, and over here, yep, you see over here, this particular candle, right, this green candle over here, it has touched the lower portion of the blue line. It means that the 10-day low has been hit. So what you'll do is you'll exit on the next day's open, which is this candle over here. So you exit on this candle over here. This doji looking candle is where you exit your trade. Okay, so this is how the original turtle trading rules work. This is the so-called their setup or their rules. Okay, so now that you have an idea, let's find out how did it perform. So number of trades over the last 20 years, right, is about 4,300. Winning rate about 36%. But the annual return, right, it's negative 0.38%. Maximum drawdown is negative 95%. Oh my goodness, doesn't sound too good, right? And if you want to look at the data over here, you can see that this is the original turtle trading rules. The backtest results from 2000 to 2019. You can see that generally this system, right, doesn't seem to be working in today's market condition. You can look at the equity curve, right? You can see that it's pretty much in the drawdown even up to today. So clearly this is a system that you don't want to be trading. But first, a disclaimer, right? The original turtle trading rules there is slightly more complex. They not only trade the 20-day breakout, they also trade the 55-day breakout. They also scale in their trades, right, as the price moves in their favor. But I've decided to keep things simple and just share the 20-day breakout without scaling in. Because again, you can do the advanced and complex stuff, but the results is still going to be the same. It's not going to be profitable. So I'd rather, keep things simple and guide you from here. Okay, so clearly this particular trading system isn't working. So does it mean that turtle trading is dead? Does it mean that trend following is dead? To answer that question, right, we need to ask ourselves, right, so what is turtle trading about? And if you think about this, right, turtle trading is just simply trend following. So it's simply, buying high, selling higher, and riding the trend for as long as possible. So let's revise back and look back. What are the principles of trend following? And once we have defined the principles, and then let's see how we can improve on things. So first and foremost, the principles of trend following is that you want to buy high and sell higher. At the same time, you want to sell low and cover lower. Number two, you risk a fraction of your capital on each trade. This means that, even if you have a loss, right, the loss shouldn't, take up a huge chunk of your trading capital. Number three, you want to trade a variety of markets from different sectors like, bonds, currencies, interest rates, agriculture, commodities, etc. As many different markets as possible, you want to incorporate them. Number four, you want to trail your stop loss to ride the trend. And number five, don't predict, just react. So you can see that the original turtle trading rules or strategy clearly has, meet these principles of trend following, right? Most of them. But I would say there is still room for improvement. For example, they originally risked 2% on each trade. To me, that's pretty high, especially for trend following system that doesn't have a high win rate. So what we're going to do is we're going to reduce your risk on each trade. Next thing, right? They trade a variety of markets. Yes, maybe in the 1980s, that were all the markets that they have. But in these days, right, you have so much more markets, right? 50, 60, 70 markets. It's not a problem, right? Especially in the futures market. And so let's, take this, right, and improve on it. So this will be the new enhanced turtle trading strategy. So now what we'll do is that instead of buying the breakout above the 20-day high, we'll go with the 200-day high. Why is this, right? And the reason is simple, right? Recent years, market has been choppy, right? There's a lot of false breakout. So what we want to do is to trade the longer term breakout so we don't get caught, right, by all this false breakout. Next thing, right? Stop loss is still the same, 2 ATR from your entry price. Trailing stop loss, we'll keep it the same, 10-day low. But the risk management, as mentioned, right, we will risk 1% of your account because 2% previously, as you've seen, right, is quite aggressive, right? Especially for a shorter term breakout trade as well. So we'll reduce our risk to just 1% of our account on each trade, and vice versa for short trades. Next thing, the markets. Now, in this day and age, right, we have access to so many more markets. So let's make use of it, right? As that's one of the principles of trend following. We will trade all these different markets over here. I think previously we had about 20 plus markets. Now we almost double it to 40 plus, maybe even 50 markets over here. Okay, so let's have an example. Let's look at an example of this enhanced turtle trading strategy. So for this one over here, again, the breakout here is the 200-day high. So what we'll do is just change this to 200, and the Donchian channel will help you plot out, right, the 200-day high and low. This blue line over here is the 200-day high, and this blue line at the bottom is the 200-day low. So now the question is, right, we will only buy when the price breaks above the 200-day high. So the next candle over here, which is this, you can see that clearly this candle has broke above the 200-day high. Right, and this candle now actually shifted, right, and made a new 200-day high on the Donchian channel, as you can see over here. So yes, the price has now meet our criteria. A 200-day high has been formed. So now we'll enter on the next day open. So next day open, which is this candle here, we go long on the next day open. Okay, which is at this price point over here, around 1.37. And then our stop loss is just 2 ATR. So very simple, just pull out your ATR indicator. Okay, pull this one out. Oh, it's already there. Okay, then you can see that the value right now is about 90 pips, right? So 90 pips multiplied by 2 is 180 pips. So you just take the opening price, which is, let's say, 1.37. You minus 2 ATR, which is about 180 pips, minus 2 ATR. And let's say you get the value is Y. So just, calculate it yourself, right? And the Y value would be your initial stop loss. Okay, so simple stuff. I'm not going to walk you through the math again. And then, if you recall, right, the trailing stop loss is the same. It's just the 10-day low. So this is where, if the price moves in your favor, in this case it did, just adjust the Donchian channel to number 10 so you can easily identify the 10-day low and wait for the price to hit the 10-day low. So you can see that the 10-day low has caught up with the price and not yet hit. Okay, still not hit yet. Okay. Aha. Over here, you can see this candle over here. The price now has made a new 10-day low. So this is where you exit the trade. So you exit on the next day's open, which is on this candle over here. This candle over here. You exit the trade. Because on this candle, it made a new 10-day low. So you exit your trade, right, on the next day's open. Okay, so now that you have an idea how this strategy works, the question is, what are the results? I mean, it's going to be positive, right? Because I shared with you at the start, right? But let's break it down further. So number of trades you can see is reduced, right? Earlier we had about 4,300 trades. Now we have close to 3,000, right? Less trades, less false breakout, less commissions. Nice. Winning rate has improved to 40.95%. Annual return has been boosted to 32%, and your max drawdown is reduced to 41%. So to look at it, the full breakdown you can see over here. This is how the trading system has performed over the last 20 years. Over here, you can see that generally this is still a profitable trading system. Okay, this is the equity curve over the last 20 years as well. And if you want to see the fine details like, the annual return, you want to look at the max drawdown, you want to see your losing rate, your winning rate, the details are all here on this spreadsheet over here. So as you can see, yes, right, turtle trading, the system, right, if you do some slight tweaks and modification, it can still work. In other words, trend following, it still works today. So 2 important lessons that I want to share with you. Number 1, the concept is more important than the trading strategy. So what do I mean by this? So a trading concept can be trend following. It can be mean reversion trading. So one trading concept, you can build multiple trading strategies around it. You can build multiple, for example, the trend following concept, you can build multiple trading strategies around it. Okay, so once you understand the concept, then you know how you can fix things, you know how you can improve things. Because for someone who just come across the original turtle trading rules, and you see that, oh, it doesn't work, they'll just claim it doesn't work, right? And say, turtle trading is dead, trend following is dead. Look at the turtle traders, right? Their rules doesn't work anymore. But no, if you think about this, if you understand the concepts behind it, you can actually tweak it and to see whether is it really dead or is it just for that particular set of time frame it doesn't work. Okay, so clearly the concept is more important than the trading strategy. And if you understand the concept, right, you know what are the things to tweak. Like for example, trend following, you can tweak the markets traded, the risk management, you can tweak your entry breakout timing, you can even tweak your trailing stop loss if you want to. But if someone who doesn't understand the concept, guess what they'll tweak? They'll add in a MACD indicator, the RSI indicator, right? They'll add in all these funny lines and stuff to curve fit the system to their own, liking and preference. And that clearly is a recipe for disaster. So the concept is important. It's even more important than the strategy itself. Number 2, you must manage your risk. This is so important because you can take a profitable trading strategy and ruin it, right, with lousy risk management. Let me give you an example. So earlier you've seen, right, that the enhanced turtle trading strategy, it works, right? 1% on each trade. Now, what if you risk 4% instead on each trade? How would things change? Again, right, just have a look at this spreadsheet over here. I have it over here, enhanced 4%. You can see that right now, this profitable trading strategy is pretty much destroyed by poor risk management. Yes, you have massive returns in certain years, but when the drawdown come, right, you pretty much went bust. You can see over here on this equity curve, you can make a lot within a short period of time, but when the losses come and you don't have proper risk management, you will give it everything all and more. So you can see that this one, annual return, 75%, amazing. But if you look at the drawdown, it's 96%. You almost lost everything while trading this strategy. So risk management is also key. Don't neglect your risk management. All right. So with that said, right, if you enjoy this training and you like to learn more systematic trading strategies that work, then here's what I recommend, right? Go down to my website over here. This one is called the pullbackstocktrading.com over here. And I want to share with you, right, a simple pullback stock trading system, right, for the stock markets. And you can see this is the equity curve over the last 20 years. Okay, I'm going to ship you a physical trading booklet, right, that looks like this. Okay, ship it to your doorstep. And I want to give it to you for free. Just all I'm asking is just cover the shipping cost for this booklet. If not, I'll go broke, right? Okay. So if this type of systematic trading interests you, then go down to the website, pullbackstocktrading.com. The link, it's over here. I'll put it below as well. And get this trading booklet. It's a 31-page trading booklet. I'll share with you the rules, the entry, same as what I've done in this video. So with that said, I wish you good luck and good trading. I'll talk to you soon.